Here are the king's terms.
Lower interest rates.
I have an offer for you.
Kiss your own arse. No rate drop for you. I fought in your general direction.
Hope you like that intro. This was a big week for interest rates for our economy, and it would have been a great week had the Fed not played politics. We'll get into that at the end of this. We were saved really this week by the BLS Jobs Report that came out today. We'll get into that. We'll show you when we go over the rates, but let's get into all the news that happened this week that was impactful to our housing market. We'll head off, again, with the big three prices. Prices are still steady. They're not really going down. We'll go over that. Inventory is still up, and rates are down. Not a lot, but they're down, and that is good news as we head into August. So what are the big news reports that came out this week? Well, homes are still appreciating. We'll go over that. Pending home sales were weak, which basically leads us into a weak August existing home sales report. Jobs week is mixed, but we ended on a good note. Fed holds tight on rates. That's a red sideways arrow. They shouldn't have done this, but they did it. But there's some interesting notes about that Fed meeting. And then inflation, we had a big inflation report. The Fed's favored measure of inflation showed inflation going up, but still it's below 3%, and it really wasn't as you're seeing in some of the mainstream media. Let's start off with home price appreciation. The Case-Shiller Home Price Index. This is the gold standard for home price appreciation across the country, and shows that seasonally adjusted, we had a 0.3% decrease in prices month over month. That's a third month in a row with contraction month over month. But we are still up year over year, up 2.3%. You can see those numbers going down, 3.9% in February, 3.4 March, 2.7 April, and then 2.3% in May. 20 city index actually was down slightly month over month, but up 2.8% year over year. So what that basically says is the big cities are really showing some more growth than the rest of the country combined. New York actually was tops. New York has 7.4% annual gains. Chicago is second at 6.1%. And Detroit is in third at 4.9%. So basically showing some resilience and ability to overcome some of their lower numbers over the course of the past couple years. So that was a really good report considering we're in a high interest rate environment. All right, now pending home sales. Pending home sales, signed contracts on existing homes fell 0.8% in June. This was after a slight rise in May, and yearly we're down 2.8% as well. Current sales pace actually drops below 4 million, down to 3.93 million. So again, this shows the impact of high interest rates on home sales. We've seen it all summer, all through the spring. It's rearing its ugly head. This is what we're seeing now. This leads to lower existing home sales for July. And we'll see those reports coming out over the course of the next 3 to 4 weeks. And now let's get into Jobs Week. There was a lot of information coming out in Jobs Week. The first report that came out was the ADP employment report. Private sector, this one has been down. The private sector, the ADP employment report has been low for the last really 3 or 4 months. Well, guess what? It showed a positive pop, 104,000, beating the expectation of 75,000 jobs. So really a big change. And you look at the difference between June, which was negative, to July, which was positive. And you see job gains across the board, no matter the size of the company. Interesting note, so pay drops. Pay drops for job stairs from 4.5 down to 4.4, and steady pay increase of 7% month over month for job changers. And we also got a GDP report really the same day, and showed the second quarter GDP, gross domestic product, was up 3%, which was stronger than the 2.4% expected. And this was also likely, this number was likely impacted by companies front-running their tariff imports in the first quarter. If you average the last 2 quarters, the GDP is an anemic 1.25%, which shows the economy is slowing down. The GDP report for second quarter alone says, nope, economy's hot. But if you look at the last 2 quarters in total, combined, actually, we're pretty flat. So that's the ADP report. We also got Jolts. Jolts, job opening labor turnover survey, drops 275,000 to 7.437 million, which is about 113,000 job opportunities less than expected. So overall, a solid jobs report on Wednesday from ADP, which again leads us to believe, well, will we see a positive jobs report in the BLS on Friday? Well, they're opposite more than they are the same. And we'll get into that later, but yeah, they were definitely opposite this month. All right, let's look at PCE. This is a personal consumption expenditure report. This is the Fed's favored measure of inflation. Yearly core rate was steady at 2.8%. And these numbers were expected. Annualized core in the twos for the 3 and 12 months, but still overall solid. We were in the twos for 3 and 6 months previous, but this month, actually the 6 month popped into the threes. So income was up 0.3%, which was stronger by 0.1%. Spending though was weak, showing there is less consumer consumption. And really what we're going to see the next couple of weeks, again, this is the Fed's favorite measure of inflation. They look at headline, but really they're looking at the core. Headline did go up to 2.6%. But one of the concerns that we're going to have over the course of the next 3 to 4 months is, and indeed for the rest of the year, is every month when you do readings, you drop the month from the previous year. And when you have high inflation in the previous year months, well, that makes the inflation come down. Well, guess what? The next 3 to 4 months, we're going to drop off very low inflation numbers for those months, month over month. What this means really for PCE is don't expect inflation numbers to go down, the core inflation numbers to go down. Expect them to stay steady, and that's not a bad thing. It's just basically comparing this year to last year, and as long as we can keep inflation low and not see big spikes, I think we're in a good position. All right, let's get into the Fed. All right, pending home sales report down. Fed doesn't care. This was the first time we have had, actually in 32 years, this is the first time that 2 governors dissented in a meeting. Basically, they did not agree with keeping the Fed funds rate the same. Governor Waller and Fed Governor Bowman both said we should drop by 1/4 point. First time in 32 years, people. That's just showing that, the Fed, not everybody in the Fed agrees with the direction that Fed Chair Powell is taking them. Economic activity did moderate. Economic activity was moderated versus expanded from the previous meeting. And really, that's all the more reason to cut, but they didn't cut. Fed Chair Powell agrees that tariffs are one-time hits on the economy. Okay, well, that's awesome. That's another reason to a cut, because it's a one-time hit. It's not something that's going to stick to the economy. Consumer spending is down. Spending on services such as hotels, airfare, and dining are down for 3 straight months for the first time since 2008. Yes, another reason to cut the Fed funds rate. And right now the Fed is so reactive that they are going to send our country into a recession. And you know what's going to save us? Secretary of Treasury Bessent taking action. They're going to have to take action to bypass the Fed. They're not going to fire Fed Chair Powell. If anything, Fed Chair Powell may resign because of really just doing a shitty job overall. Not to mention the overspend by $3.1 billion, not million, $1 billion on their building. Rest assured, President Trump is going to figure out a way to bypass the Fed with fiscal policy. So we'll see what happens. I don't think President Trump is going to take this one lightly. At the end of the day, this is really Fed Chair Powell playing politics at the expense of the American people. It's exactly what that is. The Fed is slow. They're reactive. This is what they did last year, and it didn't help out. It didn't help out our economy. So we'll see what happens. But get out your popcorn, people, because this administration is not going to put up with the Fed keeping the economy down. And we get into now the great news for the week, and I would say the one thing that again shows that the Fed is slow and old, and that is the BLS, the Bureau of Labor and Statistics Jobs Report. This report was huge. Job growth slowed sharply. All right, only 73,000 jobs added. This is the weakest monthly gain in over 2 years. Unemployment rate ticked up to 4.2%. That is the highest level of unemployment since early 2022. So again, a slowing economy. This is why the Fed should have taken action and lowered the Fed funds rate. Major downward revisions to the May and June jobs reports. Down 258,000 jobs, exposing earlier estimates were really overly optimistic. And if you average the downgrade, that's 77,000 jobs gained per month instead of the 140 or so thousand that we got initially. Hiring hits a 1-year low. The pace of hiring is at its lowest outside of the pandemic affected areas or periods. Quits rate is also below the 5-year average, which shows that basically fewer people are confident enough that they can leave their jobs and stop working. Wage growth actually cools as well, reflecting employer caution. These weak numbers, right? The weak numbers in this report, combined with ongoing inflation and steep tariffs, really raise fears of a potential recession and intensify pressure on the Fed to adjust its interest rate strategy ahead. And you know what? Here's a bad thing. That ain't meeting again until September, so we got 2 more months before we actually get the Fed making another decision. But this BLS Jobs Report really saved our bacon really this week as well. Rates had actually gone up this week, but they're back down just a little bit. We'll get into that here. The BLS Jobs Report really kept VA rates from going up towards 6.5%. We're now right around 6.34. And again, if the Fed had lowered the Fed funds rate, I think we would definitely be below 6.25, but we're not there yet. And if you look at this chart, really just kind of shows last July, the Fed did not cut the Fed funds rate. And you can see in July, interest rates were right almost exactly where they are now, right in the same range. But with continued economic reports that came out in August and early September, we saw interest rates drop down. You can see this huge drop when we dropped down into the 5s. For VA rates, and that was a big refinance opportunity. So, will we see this again? Deja vu. Are we going to see the same thing over again? What's that saying about history doesn't repeat, but it sure sounds a lot alike? So that's kind of what we're seeing there. VA rates again coming down, still above 6.25, but with continued economic reports coming out over the course of the next several weeks, we could see rates come down. Again, no guarantee. Again, a lot of economic news, but expect the president to take some action. Now, he's not the patient type of person. All right, so what does this all mean for you? Hey, mortgage apps, again, showing the summer fizzle, not a sizzle. Mortgage apps were down 6% last week for purchases. Refis were down 1% last week, but overall up 30% year over year. Fully 41% of total transactions last month were cash out refinance. It really shows us that people are in debt. People need to consolidate that debt, and they are doing that by refinancing their loans to take money out to pay down their debt and save money month over month. We could be on the precipice, as I showed you, we could be on the precipice for lower rates over the course of the next 2 to 3 months. Is now the best time to buy? Now is the best time to get in a contract because you're getting huge credits from sellers, and that is going to help you make that home affordable. And guess what you're going to do? You're going to refinance when rates come down. But what happens to all those people who are waiting for rates to come down before they buy? Well, they're going to pay more for that same home. It's not me prophesying, something, that I wish. No, that's a fact. It's going to happen. It always does. Sellers, hey, summer selling season hasn't been great. Inventory is still super high. But you know what? I'm telling you, there's some realtors out there who are crushing it. Why? Because they are staging their homes immaculately. And you know what? I tell you what, that helps so much. I was just at a house this week in an area where there's a huge amount of inventory. Guess what? Went off the market in 3 days. Why? Because it was staged properly. It was priced right. Every day a home was bought and sold. Are you going to be the one buying or are you going to be the one selling? I think who you work with matters, not just from the lending side, but also from the real estate side too. So sellers, work with the right people. If you don't know who to work with, trust me, I know some people who can help you out and get your home sold quickly. That's about all I have for you this week. Big week. We'll see what happens next week. Not a lot of news, but have a great weekend, folks, and happy intro into August and maybe some better rates ahead. All right, aloha.